Hi guys, welcome to my YouTube channel, and today I'm going to be taking you through risk management rules in Forex and synthetic indices. So let's get into it. So if you are new to my YouTube channel, please make sure you like, make sure you subscribe, and yeah, let's get into it. So as you can see from this point, what we are going to cover in this video, we are going to cover risk management, why risk management decides survival. We are going to talk about the 1 to 2% risk per trade rule. We are going to talk about position sizing and stop loss placement. We are also going to talk about risk to reward and leverage discipline. We are also going to talk about synthetic indices. We are also going to talk about loss limits, drawdown, and psychology in trading. So let's get into why risk management decides survival. So risk management, if you want to survive in the forex markets, well, you don't need to go into the markets and just place a trade. You need to follow a set of rules in order to make sure you are profitable, or you are much profitable in the forex markets. So you cannot just come into the markets and just click on buy, sell everything, and you don't know how much you are willing to risk. You don't know how much position you are entering into the market. Maybe you don't have enough capital. You are oversizing your positions. You don't have stop losses. You don't have a plan for your losing streak, and and everything. So this is why risk management decides survival. So if you don't have any risk management in the forex markets, then obviously the market is going to keep you out of the markets, because you need to follow a certain set of rules in order to be profitable in this market. So risk management is needed in order for you to survive in the forex market. So with that, let's get into it. So rule number 1 to decide you survive in the forex market is never risk more than 2% per trade. So this is a simple rule. It is a single rule, but it is very simple. But the simple it is, the harder it is to execute. So you find people are entering, like they are risking like 10, 20%, 30% of their account. And the more you are exposing your account to risk, the higher the market is going to, the more your account is going to suffer serious damage. So you need to be responsible when taking these risks. So you need to make sure you are conservative as much as possible, especially as now you are going to be trading synthetic indices. In the synthetic indices, you need to be very conservative. That's why you see from this point, I decided you only risk 0.5 to 1% per trade at most, or should I say the most amount you are supposed to risk, or the amount per trade you need to risk should not be more than 2%. You need to be very, very, very conservative, because the synthetics markets, some can be pretty volatile. Whenever you are calculating your position size, make sure the limit does not pass 2%. So on standard forex, you can risk up to 2% per trade also. But and you should never, even if you have an account that is large, you should never exceed this 2% rule, because the lower your risk is, the less the account is going to suffer more damage. So the higher the risk, the higher the damage you are going to cause to your account. So you decide. So make sure you always keep the limit. You should never exceed 2%, per trade on a single position, that is. So let's get into the next one. So the next one is position sizing. So always calculate your position size every time before you get into the market. So have you ever gotten into the market and you don't know how much you are risking? You're just like there, you go in and enter like 0.1 lot size. You don't know how much you are risking, you don't know how much your margin is, and everything. So you need to stop that. You need to always calculate your position size whenever you enter into this market. So you should never take anything for granted. So to calculate your position size, you need equity times risk in percentage divided by stop loss distance. So for example, in Forex, you have an equity of $10,000. Your risk per trade is 1%. So that is $100 of $10,000. So your stop loss distance is 25 pips. So if you do the math, it's going to result on a 0.40 lots position size. So if you want to risk $100 in that trade and the stop loss distance is 25 pips, you need to enter a position with 0.40 lots in order to to get into that market. So you have calculated your position, and the position that you are going to be placing. And the other thing is, you should never enter a trade without knowing where you are going to put your stop loss and where you are going to put your take profit, mind you. So always take care, guys. Always make sure you enter a position with a stop loss in place and a take profit in place. So yeah, and as you can see, from this other side, we had a worked out example of synthetic index. So you can see this one is a volatility 75 index. So the same also as the Forex example. So nothing more. And you should never recalculate your position sizes for every trade, and never copy a previous lot size across instruments, because all instruments are different. So you have this instrument has a certain estimated buy margin. So the estimated buy margins are not always the same. So you can find some instruments offer different. So when you do the calculations of position size, it totally brings a different value. You need different stop loss distance and everything, and you get different resulting position size. So always make sure you recalculate your position size for every trade, and I cannot emphasize this enough. Always do your calculation, always know how much you are risking, and always make sure you are comfortable with that amount, because you don't want anything to do with emotions in trading, so that you are over risking. Please put that into consideration. So let's go to rule number 3. Rule number 3 is stop loss and take profit discipline. As I have talked about this, you should never enter a market if you don't know where you are going to set your stops and where you are going to target. So as you can see, rule number 3, set the stop loss before entry. Always, you never know when you enter into that position if it's going to reverse. So for you to be on the safe side, always set a stop before entry, right? So you can do that by going to create an order. First, you ensure you put your stop loss and your take profit, and then you execute the order. So make sure you follow that. So always look past the swing points and volatility bands, right? Your stop loss should never put randomly. You should always aim at the swing points, the numbers that where the market has already swung. So the market has a lower chance of going past that limit or going past that level, and that's why you should be targeting your stops. So always define your take profit up front, I have talked about this. Take profit. Always set a take profit before before you enter into a trade. You should always know where you are going to exit the market from, and always have a trailing stop loss plan. When the price reaches 1 to 2, you drag your stop loss to break even, and when it reaches 1 to 3, 1 to 4, you continue moving, trailing your stop loss in order to lock in profits. That is very important. Otherwise, the market goes on and it reaches almost 1 to 3, and you are not trailing your stop loss, and the market decides to reverse. It's going to come back. It's going to go back into drawdown, and it's going to stop you out, and you're going to have a loss. So yeah, this always make sure you have a take profit plan and a trailing stop loss plan fixed before you trade or before you enter any trade, right? Yeah, let's go to the next one. Make sure you do not widen your stop loss. Once you set your stop loss, you are preventing your account from losing more money. So if the market decides to reverse, let it come and take you out. And once you see the market has decided to go to the direction you want, and you have already confirmed your confidence, you have seen everything is good, you have calculated your stop loss, you have calculated your position size and everything, your take profit, you just get into the markets. And you should never widen your stops, guys. I cannot emphasize this enough. So always make sure you trade, you put your stop loss, but you should never ever think of widening your stop loss, right? Yeah, let's get into the fourth rule. So the fourth rule, only trade a favorable risk to reward ratio. So what's a favorable risk to reward ratio? You can have a good risk to reward ratio that's such that you can have 5 losing trades, and when you have that one winning trade, it cancels out all your losses for the 5 trades, and it leaves you with some profits. So how does this work? Let's say your take profit is a 1-to-1. So a 50% win rate is needed for you to be profitable, because let's say you are risking like $100, right? Now, for you to have a 1-to-1 risk to reward ratio, you need to open a position with that $100, right? And you have to make that $100 back for you to have a 1-to-1 risk to reward ratio, right? So that is not a good risk to reward ratio, since if I have 3 losses, and then I take another position, I win, and I'm at a 1-to-1 risk to reward ratio, you can see that I'm still in drawdown. But if I have a 1-to-3 risk to reward ratio, I lose 3 trades in a row, right? And then I take one winning trade, and I target a 1:3 risk to reward ratio, right? So I am going to be at break even in that account. So you can see how that risk to reward ratio differs regarding to how you apply the risk to reward. So yeah, as you can see from this point, if you have a 1-to-1 risk to reward ratio, 50% winning rate is needed for you to be profitable. But even if you have a 1:3 risk to reward ratio, you need a small win rate for you to be profitable. That's exactly what I mean. As you can see from this graph, the lower the risk to reward ratio, the higher the win rate is needed. And the higher the risk to reward ratio is, the lower the win rate needs to be for you to be profitable. So let's get into the next rule number 5, leverage and margin discipline. So leverage amplifies both outcomes equally, Higher leverage does not increase edge, it only increases the speed of ruin. So what does this statement actually mean? Leverage. So average does not increase an edge. In fact, it says it only increases the speed of ruin. So what is leverage? Leverage is whereby you have the power to open large positions with smaller capital. So this leverage can also be a double-edged sword. So you can make more money with it, and you can also lose too much money with it. Yeah. So on Forex pairs, the maximum effective leverage you need to be using is 10:1. And the second one is exotics. So on exotics, the maximum leverage you are supposed to apply is 5:1, and on synthetic indices is also 5:1 or less. So yeah, and on news and high impact events, the maximum leverage, you should be flat, you should be 1:1. Yeah, let's get into the rule number 5. So rule number 5 is loss limits. So loss limit stop a bad day from becoming a bad month. Once a threshold is hit, trading stops for the period. No expectations, no leverage, no revenge tradings. No revenge. So no exceptions, no revenge trades. So a single trade, you take a single trade, you risk 1 to 2% of equity, right? Now the maximum daily loss limit is 3 to 4% of the equity, right? Now weekly loss limit is 6% to 8% of the equity, and the monthly loss limit is going to be 10 to 12% of the equity, right? So once you hit that loss of the day, just walk off the charts, just take a break, go do some sports, take a walk and everything, and you come back the next day fresh and cool to take another setup. And you analyze your charts. If you find a setup that you are willing to take, if you do your position calculation, you enter into the trade, and yeah, everything goes as planned. So yeah, once you hit a limit, a mandatory stand down is needed. You should not open another position to say like you are revenge trading, or you think you have hit a loss, and then you are in the markets looking for a setup in order to chase back the money you lost. So I would not recommend you do that. So once your daily limit has been reached, or your weekly limit, or your monthly limit, so in our case, you're going to focus on the daily limit because you're going to be doing trading on a daily basis, right? And so once your daily limit is reached, you should step away from the charts, go take a break, cool off, take a walk, and maybe do some sports and stuff, relax, and come back the next day to the charts and do your analysis and everything. And yeah, so standard protocol: once your daily limit is reached, close the platforms for the remainder of the day, right? Once the weekly limit is reached, no new trades until the next Monday. So you see what I'm talking about? You have that discipline. Once that discipline arrives, or once that limit is reached, no trading until the next Monday. Log the losing trades and identify the broken rules, if any. So you should always analyze your losing trades and your winning trades. Ask yourself, why did this trade become a losing trade, and why did this trade become a winning trade, right? Identify if the rules were broken, and if any, please record also on your trading journal, right? yeah, so, and the last thing is resume after a written review of what happened. So once we review, you have seen that your rules have been broken. Always write and review why that happened, right? So once you review what happened, come back the next day, do your analysis, and make sure you avoid the same mistake that you did the other time. So yeah, you always learn from mistakes. So yeah, let's get into the seventh rule. The seventh rule is psychology and execution discipline. So 1, never trade without a plan, right? Or trade the plan, not the emotion. Every time matches are predefined setup. No impulse trades from boredom or fear of missing out, right? Or FOMO, if you like to call it. No revenge trading. Once you reach a loss, no revenge trading. Like, you made a loss of $100 and you're like looking for a setup to make your $100 back. No, don't win it back. Just walk off the charts, take a break, and come back the next day. Analyze the market, find your setup, trade, just like that. And yeah, the next thing you're going to talk about is to journal your trades. Always journal your trades, your entry, your reasoning, emotions that you experience during the trade, and you should review your journal every week, right? See how your account is doing, right? See whether you need to put in more effort on your strategy, on your plan, right? So yeah, always journal every trade and do your review weekly. And number 4, separate trading capital from living funds. Always risk the amount that you are willing to lose, because this is a Forex and synthetic indices tradings are very risky markets, right? So always separate your trading capital with living funds, right? So only risk capital that does not affect financial obligations if lost entirely. So let's go to rule number 9, is drawdown math and recovery rules. So once you're in drawdown, you need to have a plan in order to recover from the drawdown, right? The deeper you are in drawdown, the harder the recovery becomes, which is exactly why earlier we said the rules on the deck exist. If your maximum drawdown is 10%, you should cut your position size by 25%, right? And if your maximum drawdown goes to 20%, you need to cut your positions by 50% and review your strategy ASAP. If your maximum drawdown is 25% plus, that is 26, 27, 30, you need to stop live trading and resume demo or journal review phase. So you should get off the charts, go review your strategy, go back test on the demo, right? Yeah, in order to know what's wrong with your strategy. Your plan is maybe the one that's letting you down, your risk to reward ratios, your position calculation or recalculation of the positions, lot size. That's what I mean, if you don't get what I mean. And yeah, once you review everything and you see that in your demo trading you are good to go, get back into live trading and yeah, continue everything. And yeah, let's get into the final. So as you can see, we are finalizing. Before you click any trade button or you click trade, this is a recap of what we have talked about. So always make sure you review your position size, make sure position size is calculated well, make sure your stop loss and take profit are set before entry, and the stops should never be adjusted to avoid a loss, or should never widen your stop, right? Your risk to reward should be at least 1:1.5, and always position within the 2% rule. So your leverage and margin usage should be within the account type caps, right? Synthetic index trades size for continuous spike from volatility. Daily and weekly loss limits should always be respected. No trading past a triggered limit. So once you reach your daily loss limit, walk off the charts and everything. So yeah, correlated exposure and total open risk checked across all positions. So trade matches the rated plan, entry and reasoning logged into the journal. So any drawdown threshold should be immediately acted on, immediate per the recovery rules, right? Yeah. So that is the end of the video today. If you liked the video, please make sure you like, make sure you subscribe, and yeah, I'm going to see you in the next one. Thank you for watching.